This is video 2 in the 3-video series about working capital in the context of the sale of a business. There's a lot of confusion about the treatment of working capital when selling a business. Working capital features in business valuations, sale price allocations, and sale adjustment calculations, to name just a few. Most business owners and even some advisors don't understand how working capital can impact on the goodwill of a business and how it is accounted for in the context of a business sale. The consequences of not knowing can be dramatic, with owners giving away substantial value without even realizing it. The topic is too broad and too complex to cover in a single video, so we've broken it into a series of 3 videos so each aspect can be properly explained. This is video 2 of the series of 3 videos, specifically on working capital in the context of the sale of a business transaction, aiming to clear up any misconceptions and explain how optimizing working capital can benefit the existing owner. In this video, we'll cover these aspects: how working capital is accounted for during the sale process. Are working capital assets and liabilities sold when a business is sold? When is working capital included in the sale and when it is excluded, and why? What are the differences in treatment when company assets are sold versus company shares? Why the need for a working capital adjustment? How do you account for differences between the working capital requirement and the actual working capital balances at completion? Working capital is part of the overall enterprise value of a business, regardless of which components are sold with the business. Are working capital assets sold when a business is sold? When is working capital included in the sale, and when is it excluded, and why? Regardless of whether any or all of the working capital elements are sold or transferred to the buyer at completion, ultimately, the assumption is that all asset elements will be realised by the seller, either by receiving the money from the buyer or from their customers in the case of debtors. And all liability elements, e.g. trade creditors, will be either paid out by the seller, after sale usually, or adjusted in favour of the buyer, who will then pay them out. So regardless of whether a given working capital component is sold with the business or not, the value of the business is the same, and the overall gross proceeds to the seller, before any taxes, should be the same either way. It doesn't matter where they get the money from, whether it's from the buyer or from their customers, they should still get the same gross proceeds before tax. Conversely, for the buyer, regardless of who they pay, they should still invest the same overall amount, being the enterprise value. So if they buy the debtors from the vendor, then they're paying for them up front. If they don't buy the debtors and the seller collects them direct, then the buyer still has to set aside or be prepared to finance an equivalent value as his debtors book builds over the first maybe 2 or 3 months of trading, depending on the business model. Same with trade creditors. What are the differences in treatment of working capital when company assets are sold versus company shares? Normally, but not always, working capital is included in the company when the sale of company shares is the way the transaction's going. In other words, the trade debtors, the trade creditors, and all other working capital items just stay in the business and are carried straight through to the buyer. Often, but not always, when the business assets are sold out of the company or entity, for example, then the inventory or stock will be sold, but the debtors and creditors may not be. So as we've said before, the debtors and creditors may remain with the vendor, who will then collect the debtors and pay the creditors. A working capital analysis is required in all cases, regardless of whether the transaction is the sale of assets or company shares. If it's a share sale, then you need to define the nominal working capital at the start and build in an adjustment at completion. Because the debtors and creditors and working capital are going to be transferred, you need to allocate or decide what's the nominal working capital of the business. and that will be the designated amount. It's important for this reason that you have a number locked down for the working capital requirement of the business, and that's a component of the total enterprise value. So why is there a need for a working capital adjustment, usually after completion? Working capital adjustments are usually only required when the key working capital components are being sold to the buyer at completion. Working capital adjustments for sale purposes are often designed to cover the fact that cash will be removed from the company by the seller before completion, usually in the case of a share sale, or not transferred to the buyer, usually in the case of an asset sale. If every part of working capital operated as a contained box, sometimes called a locked box, including cash, there would probably not be the need to provide for a working capital adjustment. However, because the cash component is often removed or excluded at completion, a way to compensate for this is required if the value of the net working capital at completion is above or below the deemed working capital requirement. For example, if the only working capital item that we have to deal with was trade creditors, and the deemed amount was, say, 1 million, and if the value of completion was, say, 1.5 million, then you would need to account for the difference. This is because if you were the seller and instead of leaving $1 million of debtors in the company and handing the company over to the buyer, you left $1.5 million of debtors in the company, and that was, say, $500,000 above what's normal, then you'd be leaving $500,000 of extra sale price in the business for the buyer without having the cash to compensate. So there has to be an adjustment mechanism to level the playing field and bring it down to what's normally expected or normally on hand in the business, being the $1 million we nominated. Conversely, let's say the debtors were only $500,000 at the time of completion, even though they normally run at $1 million. Where's the extra $500,000? It's clearly in the seller's pocket because they've collected the cash. So the buyer would only be getting $500,000 of debtors in the company they're buying at settlement, and the debtors would presumably return back to the normal level of $500,000, but they won't have the cash to fund it. So the adjustment mechanism again levels the playing field. And that applies to all working capital elements. When selling a company, it is impossible to prepare the final financial statements, balance sheet and profit statement, containing all the relevant asset liabilities at the day of completion on the day of settlement, on the day of completion. It just physically can't usually be done. This isn't just for working capital, but it's for all the other assets and liabilities associated with the business. The traditional way is to establish the true working capital requirement, as we've spoken about, and perform the sale based on a pro forma balance sheet, often using a recent accounting period, for example, the end of the previous month, if the accounts are available, and settle the transaction on the basis of those accounts, and after completion, produce a set of final completion accounts that are as at the date of completion. They need to be agreed between the parties, and any differences between the values in those final completion accounts and the accounts that were used on the day of completion are adjusted for in favour of whoever they need to be. And by adjusted for, I mean the difference is calculated and either more money is paid to the seller or some allowance might be made back to the buyer. The preference is for the money to continue to flow in one direction, so quite often there will be a retention of a certain amount, like 10% of the purchase price, so that the money always continues to flow from the buyer to the seller and not back again. This completes video 2 in the 3-video series on working capital in the context of the sale of a business. We hope you're enjoying the series and look forward to bringing you the 3rd instalment shortly. Visit tonybrown.net for these and related videos about the sale of businesses. Cheers.